Good morning, everyone. Welcome to our webinar on Canadian departure tax. My name is Paula Owen, and I'm a tax director in our Calgary office. And I will be presenting with Emily Yu, who is a tax director in our Vancouver office. Hi, Emily. How are things in Vancouver this morning?
Otherwise, it's great, and I'm excited to be here. Two of our managers, Min Zhen and Angie Feng, are our panelists behind the scene today, and they will facilitate the questions from participants. Thank you, Min. Thank you, Angie.
Great. Yes, we're all very happy to be here, and we hope that this is a very informative session for you. Our webinars do count for CPE and CPD credits. To earn the CPE and CPD credits, you must complete all of our polling questions. And then after our presentation, our team will email you a certificate for the course. Please ask questions. As Emily said, we have some members of our team in the background in taking those questions. And at the end of the presentation, Emily and I will try to respond to them. We will provide you with a survey after the webinar. We would really appreciate it if you can complete the survey and provide us with your feedback. We're always striving to improve, and having that feedback from you is really valuable to us. Lastly, we do offer closed captions. So if you would like that to pop up on your screen, please select the button to do that. So we'll just go to our next slide. So today we're going to be focusing on individuals and talking about departure tax. However, corporations or trusts should also be considered when you are leaving Canada because they can also have significant tax implications. But today we will cover residency. Your tax residency will determine how Canada taxes your different sources of income and whether or not you may be subject to departure tax. So we'll explain what departure tax is, and we'll also cover what you need to do to post security with the CRA to defer paying that departure tax. We'll talk about filing that final tax return with the CRA and what special forms are required in that final year. And lastly, we'll discuss what happens when you come back to Canada and the election that you can take to unwind or adjust your departure tax when that happens. So I will pass things over to Emily now to discuss tax residency.
I mentioned that Canada imposes Canadian income tax based on a person's tax residency status. So if you are a tax resident of Canada, you're subject to Canadian tax on your worldwide gains and income, and you are also subject to full Canadian reporting requirement. Or if you're a non-resident of Canada for income tax purposes, you're subject to Canadian tax only on certain types of Canadian source income. There are exceptions, but Canada generally only tax capital gains during tax resident period. So when you leave Canada, Canada will tax accrued appreciation on asset you own when you cease Canadian tax residency, hence the departure tax. Now, to determine even when you're subject to the departure tax, it is important to determine when you actually became a Canadian tax non-resident. The term resident, however, is not defined in the Canadian Income Tax Act. The meaning has been considered throughout the tax cases over the years. It's a subjective test. And based on residential ties a person has with Canada, the more ties you have with Canada, the more likely you're treated as a Canadian tax resident. There are a number of significant ties. One is having a home in Canada, having your spouse, and having your dependents located in Canada. These are significant ties. There are also a number of secondary ties. They include having personal property, a car, other belongings in Canada, social ties, economic ties, if you have you still have a job in Canada, if you're actively manage your business still in Canada, being covered under a Canadian provincial house plan, having a Canadian driver's license, or even having a Canadian vacation home. When you have sufficient residential ties, Canada treats you as a factual resident. So to avoid being treated as a factual resident when you leave Canada, avoid still being avoid having too much time in Canada. So once you leave the country, stay out of Canada and sever as many ties from Canada as possible, establishing new ties with a new country. When you do not have significant residential ties, you could still be considered what is called a deemed dividend, deemed resident of Canada, if you spend 183 days or more in Canada within a calendar year. If you're a Canadian tax resident under Canadian domestic rules, but you're treated as a tax resident of a treaty country, you could be considered what is called a deemed non-resident of Canada. So how that works is a treaty tiebreaker test. Can we have the next slide, please? Treaty tiebreak test is in Canadian and US tax treaty, but it's also in a number of other tax treaties. So this is a sequential series of tests, okay? And if the residency can be concluded under a test, then you stop here and don't go any further. Let's walk through them. The first one is permanent home. So if you only have a permanent home in Canada, then you automatically be treated tiebreak to Canada. But if you have a permanent home, say in Canada and the US, then this test is not conclusive. Then you would go to the next one, which is center of vital interest. The two parts to this one is personal and one is economic. And both of these two parts would have decided in one country for this one to be conclusive. So if you have personal in one country, economic in the other country, then you would move on to the next one. For the personal part, is where your family, your spouse, and dependents are located. Economic is where you report to work, your place of business, perhaps a place where you manage your properties. Okay, so when this one's not conclusive, the next one is habitual abode. This is where your presence in both countries is considered. So if where you spend your days and nights, and if you spend about the same amount of time in both countries, and then you would go to citizenship. That's when both countries look at whether you're a citizen of one country but not other. For this test, U.S. green card is not considered. And if up to this point it's still not clear if you're resident of one country or the other, then you go to competent authorities. It's rare that you get to that stage. But this is where both Canada and the US would sit down and come to some agreement in which country pulls you closer. Okay. Keep in mind that if you're going to a non-treaty country, this would not apply to you. So you can rely on a treaty to pull you to away from Canada. So in that case, as I mentioned before, just minimize your ties, cut out ties from Canada, and try to wait to be treated as a Canadian resident under Canadian rules. Paula, do you have any comment and
No,
question?
just a question that I sometimes get is what is a permanent home? It doesn't mean that you have to own the home. It can be a home that you're renting. Generally, long-term rental is what is required to, but just have a home available to you is what is generally meant by that.
That's right. So if you stay in hotels and
Mhm.
check in and out and take your belonging with you each time, that's not permanent home or short-term Airbnb, for example.
Right. Yeah. Yeah, I agree.
Thank you, Paula. That's
Mhm.
great. Next slide, please. Okay, we have our polling question number 1. Canadian tax residency is defined in Canadian Income Tax Act. True or false?
Test if you're listening there.
And once you select answer, please submit to have your to have that question count. For tax, for income tax purposes, a lot of times you have a term, but it's not defined necessarily clearly, and it depends on the taxpayers to decipher how that applied to them.
So residency really has an important impact, hey Emily, on determining what is going to be taxed and what implications arise in the country you're going to and the country you're leaving, doesn't it?
Absolutely, absolutely. I think we have our
Our answer.
answers. Yeah,
Yep. So that
false. Go ahead, Paula.
Yeah, no, that's okay. So most of you answered that correctly. The answer is false. Residency is not defined in the Income Tax Act. We really rely on case law to determine residency and really on an individual's facts basis. You really have to look at everybody individually.
Absolutely.
Okay, so next slide. On to departure tax. So when a taxpayer leaves Canada on a permanent basis, they emigrate from Canada, they are deemed to have disposed of certain property, even though that property is not actually sold. So if there is a capital gain after realized after that deemed disposition, that is essentially tax, and that is what we refer to as departure tax. So as Emily really described, residency is really important because once you become a non-resident of Canada, that's when that is the year that this tax would be imposed.
Mhm.
Departure tax is calculated based on the fair market value of your assets when you leave Canada. So, except there is one exception to that rule. If you're a person that moved into Canada, you immigrated in a prior year, there's also a deemed disposition on that date, and the fair market value of your assets on the date you came to Canada would be your cost basis for Canadian tax purposes. So determining the fair market value can be easy or it can be quite difficult. Of course, if you have shares that are publicly traded, it's quite easy to determine what the value is on the date that you leave Canada. But if you have, for example, shares in a private company, that can be more challenging. You either have to look to internal financing or get actual appraisal of the company to determine what your shares would be worth when you're leaving Canada. The deemed disposition is reported on your final tax return, and that tax is due on April 30th of the following year. So it's not something that you have to pay when you're actually crossing the border or leaving the country. It's declared in that final tax return. So next slide. So like I said, it applies to certain property. There is some property that is excluded from the deemed disposition rules. The first one being real property situated in Canada. So if you have that vacation property or rental property, etc., that would not be subject to this rule. Certain properties that are used in Canadian business. So if that Canadian business owns real property, that could possibly make it considered taxable Canadian property as well and excluded from departure tax. An excluded rate of interest is a registered retirement savings plan, tax-free savings account. Any locked-in account is generally excluded from departure tax. So your employer pension plan, stock options are also included in that. And then also certain assets owned by short-term residents. And what we mean by that is if you're a person that has only resided in Canada for less than 60 months, only the assets that you acquired while you were a resident of Canada are subject to this rule. If your time in Canada exceeds that 60 months, then it opens up to all your assets. So that's something that you really want to be aware of and watch if you know you're only going to be in Canada for a certain number of years. So yeah, so if you came into Canada owning a condo in Hawaii and it really appreciated over the time that you lived in Canada, but you were able to exit out of Canada before that 60 months, that Hawaii condo would not be subject to the deemed disposition rules. Okay, next slide, please. So there is a way to defer paying the departure tax. So as I said on the previous slide, the tax is generally due on April 30th of the following year. But CRA does give the option to defer paying it until a certain event happens. And those events are you either actually sell the assets, death, or you move back to Canada. So this can be a great option to help people that don't have the cash flow ability to pay the tax now, or would just prefer not to until there's a disposition of the assets. So once security is agreed upon, oh, sorry, I should back up. If the tax is more than $16,500, you are required to post security with the CRA. So they have the ability to collect on the tax if for some reason you don't end up paying it. So once the security is agreed upon with the CRA, and we'll talk about that on the next slide, the steps to defer it is you make an election with your final tax return. That election is due by April 30th. And it is really important to contact CRA and start the process of arranging security before April 30th. It can take quite some time to get in place. And once it is in place and completed with the CRA, interest will not accrue on the balance owing. And sometimes it's nice to have it all said and done. So the earlier you can get started on the process, the better. So you may wonder what happens if you do defer the departure tax. What happens if you actually sell an asset down the road? So CRA does send you a letter on an annual basis asking if you have sold any assets that the departure tax was deferred on. And you are required to report an actual disposition by sending them a list of information to the non-resident tax center in Winnipeg. So for example, if it was shares that you were disposing of, you would provide them a description of the property, the number of shares, and the date of disposition, etc. And then the tax would be due on April 30th of the following year. So next slide, please. So, so there is ways to post security and defer the departure tax. CRA will work with you. They have a really good group in this unit at the CRA. We've had a lot of success working with them, and they are very, very helpful, or at least that's been my experience. So there are various methods that they will accept. These are just a few that we'd like to mention. So a bank letter of credit or guarantee is accepted by the CRA. This is usually the most common form of security that we see posted, but there is a cost to it. The bank will generally charge you interest or a fee for doing this, obviously. Another option is if you own real estate in Canada, you can have a mortgage registered against the property and serve that as security. The property has to be free of any other encumbrances, though, for CRA to accept that as security. And publicly traded shares can also be posted. The market value has to be high enough to cover the security. And I should mention that sometimes CRA, if it's not a letter of credit, if it's a property that you're posting, CRA may need more security than what the actual tax is. So if your tax owing is $100,000, they may want the security or the property to be worth more than that to accept it as security. And I just wanted to also mention that you can post your private company shares. So we do have a lot of clients that depart Canada, and the value in what's rising the departure tax is private company shares. And you can post those as security. It's a bit more onerous. It takes more time to get that put in place. CRA will want to see a valuation of the private company shares to ensure that they do have the value that you're saying. You will need to have ownership and control of those shares, because if you are posting them as security, CRA will will have those shares subject to restrictions. You will need their approval if you're paying out dividends from the company, those types of things, because of course, if you're using them as security, they want to make sure that those shares still hold their value over time. So if you're pulling money out of the company, well, that would lower the fair market value of those shares. So just depending on the risk, CRA may ask for additional forms or additional information, etc. And it does take some time to process. Emily, do you have any other comments or experiences that you'd like to?
The only thing I add is start early. Once
Yes.
when you start to apply for this plan for your departure, start thinking about which assets are subject to departure tax and which you might use as securities. It can be a fairly lengthy process.
Yes, I really, really agree. Yeah.
Yeah, and also my apologies, my video does not seem to be working right now.
Oh no. Oh, okay. No problem. Okay, so that brings us to polling question number 2. So which assets are not excluded from the deemed disposition rules? So this is not excluded. A, condo in Maui, a B, tax-free savings plan, C, Canadian rental property, or D, a Canadian employer pension plan. And once again, we'll give you a bit of time to record your response, and please submit so those actually get submitted and we can see your responses.
So there we go.
Okay, so yes, that is correct. The condo in Maui. So if you had a condo like the Canadian rental property or a condo situated in Canada, of course, that would be excluded. But that condo in Maui would be subject to the deemed disposition rules. So Emily, I will pass it over to you now.
Okay, well, just on this, the general rules is that for the asset that Canada would always have the ability to tax after you left Canada, chances are those may not be subject to departure tax. Whereas condo in Maui, once you leave Canada, Canada may not have the ability to tax that if you sell it later on.
Right. Yes. Yep.
Thanks,
Exactly.
Paula. As Paula mentioned, that departure year return is due on April 30th of the following year. For your year of departure, even if you don't meet the filing threshold or have no tax liability, I still recommend you to file that return, even if you don't have departure tax related issues. This is to notify CRA that you're leaving Canada, and CRA would not expect you to file future returns. And also it stops, for example, tax-free savings account contribution rule from accruing. Once you determine your date of departure, that needs to be reported on the jacket of the return. And in the event that your departure is somewhat phased, that you and your family and your dependents will have different time, for example, if the actual date is not clear, reach out to your tax advisor with your facts, and they'll discuss with you and maybe visit treaty tiebreaker rules to determine what that date might be. It has to be supported by your facts, of course. Now, if you have a home buyer plan and there's an unpaid balance at time of your departure, that needs to be included in income, or you need to repay that. And for your year of move, non-refundable tax credits are prorated. This is prorated based on your resident and non-resident period. Non-resident of Canada may not be eligible for these credits. If you had medical expenses incurred or made a donation while you're a tax resident of Canada, you can claim that on the departure year return. Okay. For the departure year return, it is possible if there's a departure year return and another return. That's when if you have rental income from Canada after you left Canada, there's a different type of return. We'll talk about that a little bit later on. That's to report just your Canadian rental income as a non-resident of Canada. I think we're ready for the next slide. Thanks. There's certain special forms that you need to file with your departure return. The first one is called the T1161. This is Properties by Immigrant of Canada. This is a list of reportable assets you own at the time of your departure. You need to list each asset and its fair market value at that time. The form is required unless the fair market value of all reported properties owned is less than $25,000. There are some assets that are not reportable: cash, Canadian pension, Canadian registered account, and also property owned by short-term resident. These are the individual who had been resident in Canada for less than 16 months, as Paula mentioned. And also personal use items with fair market value less than $10,000. What is required to be reported though? Corporate shares, public, private, corporate share, bonds, debenture, promissory note, interest in trust, interest in partnerships, business properties, and also real properties. And actually what's interesting is that even your principal residence that is excluded from deemed disposition is required to be reported on this one. This form should be filed with your T1 return for the year of departure, and late filing of this form is subject to penalty of $100 per day up to $2,500. The second form is called T1243. This form is the one that declares your deemed disposition. And so any asset that's not subject to deemed disposition is not reportable on this form. So for each of the asset, identify the fair market value, adjust the cost base, and gain or loss from deemed disposition. So as Paula suggested, that if you want to defer departure tax, you will file and make an election on form T1244. And again, this is asset by asset basis, and you need to identify each of the asset and separately disclose federal and provincial tax liability from the deemed disposition. This form is still need to be filed, even if the deemed disposition tax liability is $16,500 less when security is not actually required. As a reminder, as of June 25th of this year, capital gains for individuals are now subject to potentially two separate inclusion rates. So in a calendar year, on the first $2,500,000 net capital gain, 50% is taxable in Canada. For any additional net capital gains, 2/3 is not taxable. Paula, do you have anything to add?
No, just that with the deemed disposition, that would also be included in the change in capital gains rates.
That's right.
Yeah.
Yeah. Next slide, please. So now you left Canada, or a non-resident of Canada. A non-resident of Canada might still be subject to Canadian tax on certain income, and the most often common income that's applicable for individuals, employment income for services provided in Canada. For example, if for some time after you left, you're still working for your Canadian employer and you travel to Canada to provide service, so you could still be taxable on that portion of your employment income unless exempt under tax treaty. And if you're a self-employed person and provide services or carry on business in Canada, then a portion of that business income may be taxable as well in Canada. However, if you're a resident of a treaty country, generally only business profits attributable to what is called a Canadian permanent establishment is subject to Canadian tax. Reach out to us if you're not sure whether your business has a Canadian permanent establishment, okay, under the respective tax treaty. Keep in mind though, regardless whether you have a Canadian permanent establishment, Canadian payers, for example, your Canadian clients are still required to withhold 15% Canadian withholding tax on services performed in Canada. Also, if you have a rental income from a property located in Canada, the default Canadian tax treatment is 25% withholding on gross rental income. And this withholding applies to each rental payment and needs to be remitted to CRA. There's penalty exposure for failure to timely remit. Or you can elect to be taxed based on net rental income. This is done by filing a Canadian tax return. The form is called T1159 instead of T1. Withholding requirement still applies, but it's based on net rental basis, okay? And rental income from Canada is subject to Canadian federal surtax instead of a provincial tax. And when you do sell that property, which could be a former home, the buyer is required to withhold 25% of the gross proceeds. You need to request what's called a certificate of compliance within 10 days of transaction, and that allows the buyer to reduce the withholding amount by taking into account your cost basis. Now, the withholding is a prepayment. Your Canadian tax liability is determined when you file your Canadian tax return for that year to report the capital gain. Canada also has other withholding requirements. These are often called a Part 13 tax. Common income that's subject to withholding include Canadian pension from your employer, RIF income, or dividends from Canadian corporations. There's default rates under Canadian tax rules, but these default rates may be reduced or sometimes exempt by a treaty. So what is important is that as you leave Canada, advise your Canadian payers, banks, investment firms of your departure, and also the country you will be residing in. If the Canadian tax is correctly withheld, no further action is required in Canada that represent your final tax liability, and no further return or anything needs to be done. But if tax is incorrectly withheld, write to CRA, and the paid tax under withheld will request for refund of excess withholding on a form called NR7R. And of course, provide all this information to your tax professional. Your Canadian tax liability on Canadian source income may be used to reduce your tax liability in your new country on such income. Paula, do you have any additional comments on this?
No, I don't think so. It's just really nice, like you said, if you do let your financial institutions know that you're leaving, that's because that really will dictate how they're reporting your investment income. And so instead of a T5 informational slip, you should receive an NR4 slip, and then all the withholdings will be done correctly, and that'll save you from writing a letter to CRA and remitting the withholding tax after the fact.
Exactly.
Oh, that's great.
I think we're ready for the next slide. Okay, we have polling question number 3. So when is the non-resident of Canada required to file Canadian income tax return? When you receive a RIF income, when Royal Bank withheld 0 tax on a dividend, this would be from a Canadian corporation. When you have rental property from in Toronto and you received income after you left Canada, or you're earned self-employment income through a permanent establishment in Canada?
A tricky question, Emily.
So this highlights that you need to let Canadian payers know that when you left Canada.
Mm-hmm. Yeah, for sure.
Yeah, but also be aware that your Canadian tax obligations. Aha!
Wow, excellent.
Well, this is very well done. It is a bit tricky. The D is definitely correct. C could also be correct. C would be correct that if you chose to be taxed in Canada on graduate basis on Canadian rental income. Well done.
Okay, so as you can tell, there are a lot of tax implications when you're changing your tax residency, and a number of planning opportunities if you are proactive. So both Emily and myself, as well as all our colleagues at Andersen, we provide consultation advice regarding departure planning, in addition to tax compliance. We really would like you to, you just have to be cautious when you're taking all this information in, as it is very fact specific. So it really does depend on what your facts and circumstances are, and because the answers can easily change. But there are a lot of opportunities that you can that are there, that if you act proactively, you can save some tax, either in Canada or in the country that you're going to. We're very well versed in U.S. taxation as well, and happy to assist you with and any advice. The U.S., lots of people think it's how different can it be from Canada, but there are a lot of tax differences that can be quite substantial. So we did want to provide you a few planning considerations when you're deciding to leave Canada. So the first is liquidate assets. So you may have a deemed disposition when you leave Canada that's arising in departure tax. Well, you might also have a tax loss that you want to recognize to reduce that capital gain, or just if you are actually needing the cash to pay the departure tax. And for example, if you're going, what it can also help for the country that you're going to. So some countries under the treaty will offer a bump up in basis, where you don't actually have to liquidate the assets, but some countries don't. And or for for example, in the US, some states don't follow the treaty. So you really have to look at that too. But if you want the tax basis to be bumped up to match that fair market value when you left Canada, because you're subject to the tax in Canada already, you may have to liquidate the asset, and then that will create a revised bump for the country that you're going into. Otherwise, when you go into that country and you actually sell the property, they could use the original cost basis as the starting point to determine the capital gain there, and then that may cause some double taxation. And I'll just jump down to registered accounts, because you might think that one is kind of an odd opportunity to actually liquidate or recognize a gain in a registered account, but for the same reason. So those capital gains would not be taxable for Canadian purposes, because they're, as long as you don't withdraw the money. But it could create some basis for the country, or for the state that you're going to. For example, California, again, does not follow the US and Canada income tax treaty. And if you have a private shares in a private Canadian corporation, there's definitely lots of stuff that you can do. But sometimes declaring a dividend out of that Canadian corporation is a good idea. It can reduce the fair market value of those shares, which in hand would reduce the departure tax on the deemed disposition. Also, if you have a capital dividend account balance, you'll want to take a look at that, because if you declare that capital dividend before you leave Canada, it will be tax-free for you. And otherwise, if you do that after the fact, there'll be withholding tax applied to that dividend, and it's most likely not going to be tax-free in the jurisdiction that you're moving to. If you are able to control or plan your departure date, that might also be a really significant planning opportunity. So for example, maybe you're expecting to realize a big income source in down the road. If you cease to be a Canadian resident, as long as that income source is not Canadian source income, that if you're no longer a resident of Canada, when you receive it, that would not be subject to tax in Canada. Or as well, it's good to look at your graduate tax rates. So if you leave Canada later on in the year, you're most likely to be taxed at a higher graduated tax bracket. But if you're able to plan your departure date to maybe leave in early January, and if you have departure tax, well, maybe those capital gains would be subject to the lower tax bracket because all your other income isn't also being taxed at the same time. Just to jump back to the Canadian Corp quickly, there is also some considerations for the corporation when you leave Canada, if it is considered a Canadian controlled private corp at that time. So when you leave Canada, it will no longer be a CCPC. It'll be considered an other private corporation. It'll have the corporation will have a deemed tax year end at that time, and it'll be the date that you cease to be a resident of Canada. And the corporation will no longer be eligible for the small business deduction. Trusts can also have implication, just depending on if the trust remains to be a resident or a non-resident of Canada. And there's lots of facts that need to be considered for that. Are you the person that settled the trust? Did you contribute property to the trust? Does the trust still have beneficiaries that reside in Canada? So the trust can also have a deemed disposition and just other, we're not going into all those details today, but just be aware that trust can have tax issues as well. And then there's also implications of keeping a home available or a home in Canada after you leave Canada. And Emily, I was wondering if you wanted to speak on that. Living in Vancouver, I think that you are apprised of some of those situations.
Sure. Actually, a lot of our clients do ask, can I keep my home in Canada once I move to a different country? It's definitely a personal decision, but something to keep in mind is that it is significant residential tie, especially if it's not rented to external tenants after you leave Canada. And also, Canada exempts capital gains from the sale of a principal residence, but only for the years that you can designate as such. So once you move out of the country and you're no longer using as a principal resident, over time you lose that ability or reduce that ability when you cannot designate that property as your principal resident for all years. We talked about rental and capital gains. That you realize as non-resident, subject to Canadian tax, additional reporting. But this is coming up more and more now that as people move out of Canada, they need to be aware of measures related to housing crisis. In BC, we have a BC speculation vacancy tax. We also have Vancouver empty home tax. Ontario has its own measures. So you really need to want to watch out for your funding obligations and potential tax exposure under these measures. Again, especially if the property will not be rented to external tenant if you keep it as a vacation home. And also these measures are being changed, and you just want to make sure you're keep on top of it. Sometimes it may not be easy, especially you're no longer watching or receiving Canadian news, but it can be quite a burdensome thing if you're not if you miss the deadline or are not aware of the exposure.
That's right. And
Yeah.
as we have experienced as tax professionals, the CRA has has made last minute changes to a lot of those items as well. So yeah, it is definitely something to watch.
Paula
Mhm.
mentioned that have an overall look at your a review of your asset. Many of our clients who are U.S. citizens have heard of what is called a PFIC or Passive Foreign Investment Company regime. But if you're new to the U.S., discuss with us if you hold non-U.S. mutual funds outside your RSP. There could be certain fairly harsh U.S. tax treatment if you're going to the U.S. So you want to take a look to see whether it still makes sense for you to hold out to those. And also, as you look at your Canadian corporation, keep in mind the potential tax implications of the new country. For example, U.S. has anti-deferral rules that's applicable to U.S. shareholder for controlled and non-U.S. corporation. And also, if you continue to be employed by your Canadian corporation, the corporation needs to set up a U.S. payroll because the corporation will now be subject to U.S. payroll requirement. So there are other thoughts and planning that you need to be aware of as you move out of Canada. So the earlier you start to think about and discuss with your tax advisor, the better. And we're, as Paula said, we're here to help.
Yeah, exactly. I think that's what something that we want to emphasize is it's great if you're proactive. Being reactive, you just don't have the same planning opportunities as you do if you can plan before you go. So yep. So okay, on to the next slide, please. So we also wanted to talk about what happens when you move back to Canada, what options that you have at that time. So you are able to unwind or adjust that deemed disposition when you come back to Canada. When you come back to Canada, you also have a deemed disposition and reacquisition of your assets. So the fair market value of the property when you come back to Canada will become your new cost basis for Canadian tax purposes. Basically, the thinking there is that Canada will tax you only on the income or the appreciation in your assets while you resided in Canada. So that's why there's that deemed disposition when you leave and that the reacquisition when you come back, if you come back. So it is on a property by property basis that you can elect to unwind. And obviously there's some ramifications. So you have to still own that asset. So if it's an asset that you sold while you're away, it's done. You're not able to unwind that departure tax. It can reduce it to zero. Sometimes it won't. What the calculation does is it actually adjusts the the market value of the property when you come back. So it'll adjust your new cost basis for Canadian tax purposes to go forward. So it is an election. You elect on the tax return that you file when you come back to Canada. It's due April 30th of the following year. And we would like to attempt to go through a couple examples to just try to put some numbers to this to hopefully clarify the calculation. So we'll hop to the next slide. Okay, so you can tell I have three daughters. So Taylor ceased to be a Canadian resident on November 1st. She owned 100 shares in Swift Co., a public company. Taylor paid $1,200 for the shares, and the fair market value on November 1st when she left Canada is now $5,000. And when Taylor moves back to Canada, the fair market value is now $20,000. So this is an example where there's appreciation when she left Canada. There's a deemed gain, and then it's also appreciated further when she comes back to Canada. So it's still in a gain. So if we go to the next slide, we'll just kind of walk through the calculation of or the results of what happens on that. So again, there's a deemed capital gain on departure. So fair market value of $5,000 less what Taylor paid for those shares. So she's going to report a capital gain of $3,800 on her tax return. And when she comes back to Canada, what happens is the proceeds will be adjusted to $1,200 on the deemed disposition. So her deemed gain will be zero. So if this was only a portion of Taylor's departure tax and she decides to defer paying that departure tax and posted security, at this time, when she files her return, CRA will return that security back to Taylor, and that deemed disposition is effectively unwound. So now Taylor's adjusted cost basis going forward is revised. So instead of $20,000, the fair market value of when she comes back to Canada, her adjusted cost basis will be $16,200. So it is reduced by the $3,800 deemed disposition that was recorded when she left Canada. So if she were to actually sell the stock right now, she would realize the gain of $3,800 instead of what she actually realized, which was 18,000, I believe, or just under 18,000. Yeah. So essentially, again, CRA will not tax on any of the gain that was earned while she was a non-resident of Canada. Okay, so we'll just go on to the next example. And this example is the same facts. The difference is that when Taylor comes back to Canada, the stock has actually gone down. So now it only has a fair market value of $1,000. So we'll just skip to the next slide to just walk through what that means. So again, on her deemed disposition, she has a capital gain of $3,800, which she reports on that return. So the unwinding, and sometimes I'd like to actually refer to it as an adjustment versus an unwinding, because this example will show you that that not always the gain doesn't go down to zero. So in this example, the adjusted proceeds on the deemed disposition will be reduced to $4,000 from $5,000. So she will have a deemed gain of $2,800 that the tax will be due on that return when she comes back to Canada. So she can no longer defer the tax. She has a revised adjusted cost basis when she comes back, and it is actually reduced to zero. So instead of the $1,000 that it's actually worth, it'll be reduced to zero. So when she actually sells the shares down the road for Canadian cost basis, will be zero versus the bump up the $1,000. So hopefully the stock will go up again, and she'll be able to have get her gain back. But in this example, it does show that that the deemed gain doesn't always go down to zero when the property does lose its value lower than what the deemed disposition was when you leave Canada. Emily, do you have any comments on that, or?
No, I think you covered everything that I could think of.
Yeah,
and I think we probably should try to save a bit of time for questions as well.
Oh yes. And that does bring us to the end of our presentation. So we will ask Min and Angie to provide us with some questions that you've asked during the presentation.
Thank you, Paula and Emily. That's really great presentations, and it is very interesting. We received lots of questions, but due to the time constraint, we may not able to answer all the questions. So we will ask a few questions here. The first one, how to deal with primary home in Canada that could become a secondary cottage?
Want me to take that one?
Sure. Sure.
Yeah, so I think we covered that to some extent. If you're going to be, if this is going to be a personal use cottage, it will be residential type with Canada, and also when you do sell it, Canada has the first right to tax that income, and the Canadian tax liability could be used to offset your new country's tax liability on that. It depends on where the cottage is located for. Please do watch out for the housing crisis related tax measures. We do have a number of a client who left Canada and have home located in BC, and they were a little surprised by the potential implications. So reach out to us. We'd be glad to have a closer look at your situation. And also specifically, if your this former home has a significant capital gains, we want to evaluate how the impact of your ability to claim it as a principal resident if you no longer use it.
Thank you, Emily. The next question is also related to the Canadian real property. So the audience asks, what if one has left Canada, kept home, and time has expired, and has a capital loss in the home rather than a gain?
You want me to take this one, Emily, or?
Sure.
Okay. So if real property isn't subject to the deemed disposition, as long as it's situated in Canada, I believe that was part of the Faxman. But if so at the time that you sell the property as a non-resident, as Emily said, there will be a 25% withholding tax on the proceeds that is required to be withheld at the time you sell, unless you submit and file this clearance certificate with the CRA, which in this case I would really recommend to do, because if you're actually selling the property at a loss, then you want to have that withholding tax lowered, and that's what the clearance certificate does. It estimates what your actual capital gain or loss is going to be for the CRA, and then they'll agree or disagree and allow you to adjust the withholding on the proceeds. So I hope that answers your question.
I think that answers the question. Thank you, Paula.
Okay.
Yeah. And the next question is, what are some common examples of property subject to the departure tax?
So publicly traded shares, non-registered trading accounts. So if you have a self-directed account with RBC, for example, or just a non-registered account that you're able to trade in and you hold securities, if that would be a really good example. Any real property that you hold outside of Canada, so that condo in Maui, or if you have a vacation property in California or something like that, that would be included. Shares in private corporations, all of those types of things would. So just the assets that are excluded are registered pension plans, real property in Canada. Sometimes your shares in private companies can be excluded, just depending on what's in those private companies. But
Thank you, Paula. And I think maybe we can answer the last questions. And what are the implications if someone does not have adequate security to post up on the departure?
So if you don't have adequate security to post, then you'll most likely have to pay the tax. There are ways to work with the CRA, like a bank. You can get a letter of credit from the bank, or a guarantee, and maybe that's an option if you don't actually have the cash or another asset that's available to post with post security with the CRA.
Okay, thank you. I think because of the time, we are not able to answer the rest of questions, and we will address them in the future webinar. Thank you.
Okay, thanks everybody. So please answer the survey, and we would love to know how we can improve and what topics you would like us to cover next. We really appreciate you for attending. Thanks very much, everyone.